Hey everybody, Economic Ninja here. We've got a lot of news to cover. I've got multiple topics that I want to go over, and we're going to timestamp these for you as we go, but we're going to touch on a handful of topics. One being the auto industry completely cratering in China and how it affects us here, and what Copart is doing right now with repossessions. We're going to talk about auto insurance, how it is going up, and I'm going to give you some ideas of how to mitigate those situations right now because a lot of people are freaking out on how high and how fast auto insurance premiums are going up. We're going to talk about a couple of different stories covering the bullet points of why this is happening. And then we're going to talk about real estate markets. We're going to talk about how they're addicted to easy money and everything is stopping. And we're going to show you a few charts on how you and why you need to focus on the hot markets that are imploding right now. We're talking about markets that are going to affect the entire nation that have already dropped near the entire amount that was dropped in home prices back in 2008 during the Great Recession. And this literally just happened in the last 7 months. There is amazing data out there right now that is proving that this will be the greatest opportunity in your life to gain wealth if you are prepared for it ahead of time, and that is to gain wealth in real estate. Even if you don't want to be a landlord, just the ability to buy a house yourself, but there are things you need to do to be prepared for that. So we'll talk about that too, okay? So let's dive right in. We're going to talk about the auto industry. This is out of Reuters. China's January and February passenger car sales are down 20%. It says right here, passenger vehicle sales fell 20% in the first 2 months of the year, industry data showed on Wednesday, underscoring weak demand in the world's biggest auto market, even as some car manufacturers offered reduced prices to revive demand. Now, a couple of points I want to make here. You remember that Elon Musk came out and said back in October, November, that he sees the car industry imploding in 2023. And I did a video saying I completely agree, gave my points why. Then we saw Tesla be the first to the market to rush out and lower their electric vehicle prices. Not only did they lower the price for the consumer, but they lowered it in a way that it increased the government incentives, also made it sort of a bigger bang for your buck scenario. Now Tesla has that spurred some buying, but it didn't spur enough. And now we see them lowering prices even further. This means that the auto industry is imploding right before your eyes. Now, China, think about this. Wall Street was begging, anticipating, getting excited, foaming at the mouth for China's economy to reopen because they were thinking for sure it will be just like when America reopened and everybody raced out to go on vacations, buy cars they couldn't afford, get into debt that they couldn't manage, and we're dealing with that right now. But China did something different. Not only was their economy shuttered for longer, I think they got a little smarter and they did not open up and start buying up cars they couldn't afford. They aren't racing out and trying to vacation. As a matter of fact, I just saw Taiwan is actually, the government is paying, giving you incentives to come and visit. Chinese people are not jumping into the markets and buying things they can't afford right now. And this will send shockwaves through the auto industry. It says right here, sales in February, 1.4 million units were 10.4% higher than a year earlier, a low base period when a week-long Lunar New Year holiday reduced business activity, said China Passenger Car Association. Sales of new energy vehicles, which include pure battery electric cars and plug-in hybrids, grew faster than overall market, up 61% in February on a year earlier. But last year, the central government extended a tax exemption on such products while local authorities rolled out incentives to encourage purchases. And that's the only reason these vehicles are selling, because of incentives, because of inflation. The consumer is getting smarter. The rising inflation rate all around the world is waking a lot of consumers up, and they're changing their spending habits. Yet, if you look at the overall sales, passenger car sales down 20% on the first 2 months of being reopened, all right? Wall Street is not getting its grand China reopening that it hoped for. That money is not going to be flowing to the United States like it was hoped for. Now, check this out. This was sent to me by a subscriber. I'd like to keep his identity anonymous, but it's an advertisement from Copart. Check this out. It's entitled, "Get Ready to Grab Your Vehicle Before It's Gone." What? says we've secured hundreds of recently repossessed cars, trucks, and SUVs, and we're selling them in our next Copart Select auction. Someone's loss could be your next vehicle, but only if you move fast. Well, I've got a flash for you, an absolute shocker. You don't need to move fast because even though Copart has got hundreds of repossessed vehicles, there are literally tens of thousands of vehicles that are already have been repossessed and are about to be repossessed in the next 6 months. Why? Because the American consumer is tapped out. They're done. Food costs, fuel costs, energy costs are too much to bear. They are having to walk away from debts right now, right before your eyes. I am waiting to buy my cars, my collection, going into Q4 of this year and into next year. That is when I believe you're going to have the most amazing opportunities to buy vehicles. This is not the time to race out and buy cars just because there is a slight reprieve in price and a slight uptick in inventory. And I shouldn't say a slight, because I am seeing dealerships all over California start to get full. As a matter of fact, the local Mercedes dealership has an extra lot that was blank, was empty 2 months ago. It is completely filled with those the Mercedes diesel vans. You saw huge sales of those because of the RV industry exploding over the last 2 years. People taking their government checks and going down and putting them as down payments, having these van conversions done to go travel the nation because they'd had enough. They wanted to get out. Now the sales have stopped. As a matter of fact, locally, I got a tweet on at Economy Ninja on Twitter the other day, and from one of my subscribers, and great information. Look, zero down, zero great financing terms. Just come and pick up something, please. Just sign a document for us. We have too much inventory when it comes to the RV industry. Absolutely, absolutely imploding. Now, let's do this. I got a subscriber question, and it was about the insurance industry. And the question was like, Ninja, have you seen insurance premiums blowing up? And I said, I actually did a video about this about 6 months ago, but I will touch on this because they were shocked at how high their insurance premiums are. Now, first off, I want to give you a little tip. A lot of people pay month to month. You actually save money when you pay every 6 months or once a year. Not only that, you shield yourself from future inflation because a lot of people that are on monthly, it's very easy for an insurance company to just come in and go, oh, we're raising rates this month. Oh, we're raising rates next month. If you lock in your rate and pay for an entire year, you can save a considerable amount of money. So I highly suggest people do that. And please do not try and save a buck by going with a lower grade insurance just because it's the law. If you get in an accident right now and you don't have the money or the ability to have your car fixed because you don't have comp and collision, it's shocking when you do the numbers and you look at how much more it costs for comp and collision as opposed to just comprehensive. You look at it and you're like, if I was to get in an accident, sometimes in the next 3 years, 5 years, I would be in the green. And so really go through your insurance with a fine tooth comb, read the policies well, and also be on top of the, people that talk about them, the reviews on, if companies pay or not. I use State Farm personally. I absolutely love them. All right. A really high quality insurance company. All right, here we go. Out of USA Today, car prices may fall this year, but auto insurance will cost more, and here's why. It says people are spending more money on auto insurance, and that cost is likely to continue growing. It says drivers nationally are spending on average 2.93% of their income on car insurance this year, based on an average annual premium of $2,014 for full coverage insurance, and the national average annual income is $68,800. This came from Bankrate. That amount rose from 2.57% in 2022 when the average premium was $1,771. And the difference means car insurance rates increased by nearly 14% in 2022 and 2023. That is staggering, compared with an overall rise in yearly inflation of 6.5%. So you have over doubled the amount the amount you pay for auto insurance over the annual inflation rate that the government tells you. Let me know in the comment section if you actually believe that number. And it says what's worse is rates will keep rising this year as auto insurers continue to catch up with exploding costs of repairs for vehicles, labor, and claims, experts say. And that just is the name of the game. The facts are the supply chain threw such a kink in parts for vehicles. So when car companies had to total out cars as opposed to pay to have cars repaired, it hit them very hard. And they are now simply passing that over to you. Now, think about this electric future. Rolls Royce unveils its first electric car, begins all electric goal. And sees roughly a $400,000 car. Absolutely staggering. But check this out. What states are spending the largest portion of their income on auto insurance? Right now, New Yorkers spend the highest percentage of their income on car insurance, 5%, up 1.18 percentage points from a year ago. The state's average annual premium right now is over $3,000. The national average is just a little over 2,000, so absolutely 50% higher than the national average. The high premium is likely due to the overcrowded roads in the state. This is from Bankrate again. More vehicles on the road increases the risk of accidents and thus the risk to insurers, which charge a higher rate to compensate. Florida was a close second, rising almost half of a percentage point to 4.9%, with the average annual premium of $3,100, which is up $421 from 2022. Now, as we talk about insurance, I want to ensure that you know, pardon the pun, that this is not going to end. As interest rates rise, debt costs rise, inflation continues to roar its ugly head and is just racing up higher, this is going to get worse. So you need to budget for it. It is very vital that you budget for this kind of stuff. Now, how much more can Americans expect to pay for car insurance? It says car insurance rates are expected to increase by 8.4% across the US in 2023 alone, and I have a feeling it's going to be a lot larger than that. That's the largest rate increase in 6 years, according to a report from research firm Value Penguin. Now, another thing, no longer insured. Major insurance companies drop coverage of some Hyundai, Kia vehicles after theft issues. That is something else that you need to take into account. The type of car and the auto theft rates and how your car may be getting targeted for much higher premiums and then ultimately being completely dropped by your auto insurance carrier. Now check this out. Got another story right here. And this is entitled, Heads Up, Your Car Insurance Rates Are Probably Rising. Now it says at the start of the pandemic, I was among the first responder reporters to note that the car insurance rates were remaining high despite the fact that most people had stopped driving. Very interesting. You know, so many people were at their home, not commuting back and forth to work. They were staying at home, and yet auto insurance rates were remaining high. California's insurance commissioner responded to this report by telling insurers they need to straighten up and fly right. That's some great solid advice. Now apparently they can go back to their pre-pandemic ways. The Los Angeles Times reports that car insurance bills are going up again this year. Now we just covered that, but the reason why I want to say it here is check this out. You know, everything in California and New York are high, right? We already talked about New York's prices. Californians are paying an average of $2,200 in car insurance premiums this year. That's up $100 a year from 2022. You think about that compared to New York is still almost 50% higher than California. That was something that was very interesting to me. Now, your insurer will want to see a pic of your odometer to prove what you say now. A lot of insurance companies are actually asking for proof. They're not accepting just you putting your stated vehicle mileage on there. They want to make sure they charge you for every mile out there. So consider that. Now, let's move on here to a story out of the hedge, and it's about real estate. And what is very important about this real estate story, it's entitled, Real Estate Markets Are Addicted to Easy Money. Now, you guys know that I have loved investing in real estate. I've been investing in real estate since 2001. I'm a licensed real estate agent and I've owned a couple of brokerages, but I am the worst real estate agent in history because I'm an investor. So I see these cycles. There's so much money to be made when you can time these cycles right. And these cycles take a long time to lift up then come back down, then find its trough, right? Which means you have a lot of flexibility, right? If you have more time to prepare, but this is the time to prepare because interest rates and mortgage rates keep rising exponentially. And the Federal Reserve has made it very clear, even this week, talking to Congress, that rates are going to continue to rise. They cannot get on top of this inflation. And before you see full-blown inflation like gas, electricity, food come under control, there are going to be massive disruptions and deflationary downturns in different asset classes like stocks, real estate, and other asset classes. Cryptocurrency comes to mind. You have to realize that the Federal Reserve has to break the backbone of the consumer so that they stop diving into all of these markets. Sadly, food and energy inflation is going to be the last to be affected. Now, it says right here on Friday, residential real estate brokers firm Redfin released new data on home prices showing that prices fell 0.6% in February year over year. According to Redfin's numbers, this was the first time that home prices actually fell since 2012. And to give you an idea, 2012 was the bottom, the trough of the Great Recession as far as home prices were concerned. The year-over-year drop was pulled down by especially large declines in 5 markets. Austin fell. We're talking about home prices, not home sales. All right. A lot of people tell you that homes always go up. That is absolutely not true. All right. Austin fell 11%. San Jose 10.9%. Oakland 10.4%. Sacramento 7.7%, and Phoenix 7.3%. Now, these are the highest, most exciting markets during the pandemic where everything was blowing up. That means they're going to be the first ones to fall, and I can guarantee you this. You're going to see drops on a percentage basis, home sales across the country. All right. This is like no other collapse in home prices that you have ever seen before. And it is time to buckle up and get ready. It's the greatest opportunity that I think you could ever have in gaining wealth if you're ready. Now, it says the Redfin numbers come a few days, new numbers from the Case-Shiller Home Price Index showing further slowing in home prices growth since late last year. The market's expectation, December's, the 20-city index has been 0.5% negative month over month and 5.8% year over year. But the numbers came in worse. And that is something that we are continually seeing over and over again. The professionals that went to school that have the name badge that says we're allowed to give you financial advice are consistently wrong. And what you're seeing is the truth coming out months later through revisions, quote unquote. And they revise the numbers to a more truthful, more realistic number. And these are always proving the smart guys in the room wrong. So where does that put you and I? I'm going to be honest with you. We're going against the flow and we're going to absolutely crush it in this real estate downturn. It says for December, the most recent data available, the index ended up showing month over month drop of 1.5% seasonally adjusted and a year-over-year gain of 4.6%, not seasonally adjusted. Now, I want to remind you, and we're going to show you some charts in a little bit, showing a little bit of a reprieve, a little bit of a jump in price per square foot nationally, medium home prices in certain markets in December. And the reason why, if you remember back between November and December, everybody was expecting the Federal Reserve to finally ease up on these rate hikes. They went from 75 basis points, 50 basis points, and then finally, they're going 75, 75, 75. All of a sudden, in December, Jerome Powell came out and announced 25 basis points. And they were like, yes, the end is near. We're seeing the interest rate starting to do this, and eventually slowly, not slowly, but soon they're going to drop. And that's what the markets needed. That's what the housing market needed. The stock market needed. All kinds of markets need this. It's like monetary heroin, right? So he came out in 25 basis points. It looks like we're doing our job. We're breaking the back of the real estate and other asset classes. And so it looks like we can get away with 25 basis points and possibly 25 basis points again. But now, look what's happening. Blowing away expectations when we're talking about job numbers. The Federal Reserve is going, we're going to have to raise more aggressively. And the market is shocked. We just saw the 10-year bond crest 4%. That is staggering. Why? Because A 30-year fixed right now is well over 6% with excellent credit and 20% down. People cannot afford these home prices, so they are going to eventually drop. And I'm not kidding when I say they're going to drop like a rock. If you've been listening to people that say they're experts in the field and that real estate doesn't drop and it's only dropped once for 5 months, they are wrong. It hasn't happened. I'm going to show it to you on some charts in a second. By most accounts, the rapidly slowing market faces headwinds thanks to rising interest rates, including the standard 30-year fixed mortgage, which now is back up over 7%. And when they say 7% and I say 6, it's because excellent credit. There's a difference between government conforming loans when you have an 800 credit score as opposed to something in the high 6s or 7 or low 700s. That puts home ownership out of reach for many first-time buyers and is also a big distinctive for current owners to move up into higher priced homes, since any new home would come with a much higher mortgage rate than was available a year ago. As a matter of fact, there's still a rabbit in the hat that the government can pull out. I just did a video on the real estate crash course about it, and I went into depth. But if the Federal Reserve, in conjunction with the U.S. government, goes, you know what, let's back a longer term loan, a 40-year or 50-year loan at lower rates, we are going to see a tragedy in the real estate market, and there are going to be specific things that you need to do to take advantage of that to make a ton of money. But you got to move quick. And so that's why I put that in the course, because that is a rabbit in the hat. We could go from a 30-year government conforming loan to a 40 or 50-year loan, no problem, which also has some big downsides to it. But it's simply like what happened when government conforming loans went from 10, 15 to 20 years to then 30 years in the 70s. It says right here, not surprising, demand for new mortgages has plummeted out of CNBC, reported last week. Well, that's really good because the Economic Ninja has been reporting this for 2 years, and finally CNBC is getting on board. But that's what happens with the mainstream media. They report what happened back in the past, whereas people like myself and other great channels on YouTube are trying to show you what's coming in the future because of current actions right now by the Federal Reserve and the government, okay, when it comes to monetary policy. It says mortgage applications to purchase a home dropped 6% last week compared with the previous week, according to the Mortgage Bankers Association's seasonally adjusted index. Volume was 44% lower than the same week 1 year ago, and now is sitting at a 28-year low. That is exciting. I mean, I'm going to be honest with you. I get pumped when I see numbers like this because I am preparing. I know that you are preparing because this is literally going to be the greatest opportunity in your life to gain wealth. It says, so sales have fallen, and at least according to Redfin, prices are falling too. This is what we should expect to see in any environment where the real estate market is not being incessantly fueled by easy money from the central bank. After all, easy money for real estate markets has been the main story since 2009. And let me stop there. There are a lot of people on YouTube that talk about their real estate gurus and they're crushing real estate. And let me remind you that they bought their first home sometime in the last 10 years. It is approved, in fact. I mean, you can rarely find anybody on social media that's talking about, hey, I actually owned homes and sold them before the real estate crash. Most people have only experienced eternal prosperity because of Federal Reserve easy money policies, one of which being ultra historical low interest rates, which made mortgages the lowest they've ever been. As a matter of fact, during the pandemic, mortgages hit the rock bottom, lowest they've ever been in history. So it is no wonder why home prices exploded and demand for homes. So many people that were always priced out of the market, did not make enough, suddenly found themselves being able to buy a house for a brief period of time for the same or just a little bit above rent. And it caused an explosion to the upside in real estate prices, valuations. So understand that's very important. Now check this out. Without central bank propping up mortgage-backed securities demand, remember that key phrase. That's the big headline from back in 2008, all right? In the secondary market, primary market, mortgage lenders have fewer dollars to throw around. So it looks like there may be an intervention soon, right? Because lenders have less money to spend because it's more of a risk-off attitude as mortgage lenders start to really price in risk and with the inflation exploding, we haven't seen this since the early 80s. So we have literally the perfect storm when it comes to the real estate market right now. And again, I'm sorry that I'm smirking because I'm pumped. And I want to take as many of you with me. I want to see 1 million of you make $1 million during this time. Remember, more millionaires were made during the Great Depression than any other time in recent history because of amazing opportunities, because of rock bottom prices, and because of disparity. All right, I want you to be the shining light in the economy. I want you to go out and crush it, and I want you to make a difference in this world. That's the most important part of this formula. Now it says even worse, the continued income or nominal income growth that does exist is not keeping up with the price of inflation. The result has been 22 months of low or negative real wage growth, and that will translate to falling demand. Very important for people to understand that. It says here, it's clear that once markets think the Fed may again increase its MBS purchases, mortgage-backed securities, home prices again will surge. This close relationship should not surprise us since the volume of MBS purchases is a sizable portion of the overall market since 2020. The Fed's MBS stockpile has equaled at least 20% of all household mortgage debt in the United States. In early 2022, Fed-held MBS assets peaked at 24% of all U.S. mortgage debt, but they still made up over 20% of the market as of late 2022. Let me give you a really high elevation view of the MBS market. When the Fed steps in and starts buying up these securities, right, mortgage-backed securities, banks go, man, what do we have to lose? We can underwrite things that we weren't wanting to underwrite earlier. We can loan money to people that maybe, let's say, has a little bit questionable credit history. Yeah, their job might be questionable, and where we were taking on all the risk in the beginning, and we didn't want we didn't want that exposure, so we would ask for higher fees, demand higher fees, ask higher rates, things like that. Well, man, if the Federal Reserve's going to backstop us and essentially let us loan it to them, the money, we get to charge the fees, and then we get to go and sell that asset to the Fed, which means they're going to backstop and cover us. Well, shoot, let's get a little risky. So what they do, they start to drop things. They start to open up the floodgates of lending. And that's where things get dangerous. Now, we saw this in the Great Recession, and it led to even more catastrophic losses overall, but it took time. So that's something that banks and lending houses right now are waiting for. They're literally foaming at the mouth. They can't wait for it because they want to be able to open up the floodgates, because banks make money a couple different ways. And one of the main ways is through interest on mortgage, short-term loans, unsecured loans, things like that. So people need to be ready for that and understand that when that shift happens, there's going to be another little bit of flurry of home buying. But let's talk about a flurry of home buying. Let me write this down real quick. All right, we're going to show you some charts right here. And this is from the St. Louis Fed website. And we're going to show you first housing inventory median listing price in California. And the reason why we're going to focus on California right now, and sorry, the chart is going to be backwards because I got to be able to look at myself. I need to see these timestamps so I can put together the chronological order of this video for you guys. We're going to notice the housing inventory median listing price, where we saw this peak in 2022, right over here, right? You saw it drop. Now there's a little bit, you're gonna go, Ninja, wait a minute, there's this little uptick right here. That uptick is what we were referring to a little earlier ago. And that was December of 2022, when the market was getting elated. We saw mortgage rates dip. Why? Because the bond market was signaling, I think we're getting closer to tapering, or at least the Federal Reserve is gonna stop raising rates. So we had some selling, we had rates come down, the 10-year bond came down, which means mortgage rates came down, and we saw a slight increase, an uptick in purchasing of homes, right? Not very substantial, but like you see right here, you see it drop quite significantly, and then this little uptick. Now, this is what I want to point out. You're about to see that do this, and this is the exciting part of my editing. We're going to add a little line. And the reason why we're adding this line is because the jobs numbers and other data points are coming out that is pushing the Federal Reserve into raising rates. And now we've already seen the Fed funds rate when they were saying, man, we're going to have to go from 4 to 5. And people are like, no way. That's going to cause things to crater. I was one of the ones advertising or talking about this. Now they're going, oh, we're going to have to go from 5% to 6%. That's going to send a 30-year fixed rate for not the most perfect credit scores into the 9%. What do you think that's going to do to the median listing price in California? You guessed it. The reason why we want to talk about California is because it leads the pack, right? There's so much money involved in all the real estate in California because it's worth, when you combine it all, there's so much purchasing power. When that purchasing power dries up and it starts going down, and to give you an idea, the median listing price peaked at $775,000, right? It's now sitting at around $690,000. That is a massive drop on a percentage basis. And this is literally since June. This is a fast decelerating train right now. Now let's look at the median housing the housing inventory, the median listing price per square foot in the United States. So this is an average over the entire United States, the median listing price per square foot, a really neat gauge to use. Now we see something sort of similar on the chart, right? Same time frame from right around 2016 till current, and you see the listing price that was going straight up, all the way up really nicely over the last few years, and this is obviously that slight recession in 2020. You see it peak out right around here, but then all of a sudden a nice drop and a tiny little bit of an increase. Why? Why? I tell you the exact same reason it did in California. As mortgage interest rates dropped, there was a slight uptick in buying frenzy, and people go, oh, I could afford a little bit more for a house. I tried to look for a house and look at my mortgage numbers. I'm like, well, I can only afford this much per square foot. But a month later, all of a sudden we had a drop in rates and I can afford this much. And that's why it dropped. But once again, you're about to see over the year 2023, and please keep this, remind the ninja about this in September, in December of 2023, and the chart's gonna look like this. I should put it up somewhere. That's why I say that this is the greatest opportunity in history to buy real estate. Mortgage rates are going to keep going up. The Federal Reserve is going to try and pull a rabbit out of the hat, including the government, to try and keep this boat afloat. But the problem is they have lost control. You're going to see tiny little upswings, but then big downs. Another little upswing called a dead cat bounce, and then something down. The point being is this: things are getting bad and they're accelerating. But this should get you excited. Why? Because this is the opportunity of a lifetime. You will be one of the only people diving in when the masses are running out. That would become the difference when you add knowledge and then use wisdom to put that knowledge to work. You will become an investor and not a speculator like everybody else in the crowd. Guys, I hope you got something out of this. I thank you for everybody to hit the subscribe button and hit the thumbs up button. I really do appreciate you, and I cannot wait to ride this train of excellence and success with you. With that being said, the Economic Ninja is out.